Hello everybody. In our presentation, we are going to try to answer the following question. External debt, short-term gain, long-term pain. So we will focus our report on the relation between the financial openness and the economic growth. So our presentation is divided into 8 parts. Firstly, we will present the historical context, then we will make an introduction to establish what was already made and what contribution we are going to try to provide. In the theoretical part, we will establish the way by which the authors of the paper of 2006 arrived at the result of their research. We are going to take it for granted and we will just show their result without proving them. Then we will explain how we want to integrate our systemic risk. For that purpose, we shall present secondly the various data we selected to start our analysis. After that, we will enter in the econometric part. So we will discuss the statistical model, specification testing and interpretation in order to present results. Finally, there will be the conclusion of our work, which will be finished with some limits and criticism. So now the context. Following a period of favorable global credit conditions and ST debt buildup, the international debt crisis of the 1980s exemplified the extensive social and economic costs brought about by a debt distress, with effect adverse on growth performance. The adverse effect of large sovereign debts and their sustainability in developed countries have impacted to some degree the debt predicament faced by developing and emerging economies in past decades. For these countries, with limited policy tools with which to address economic shocks, debt management and its sustainability have remained a major concern. Also, the global situation of these economies has markedly improved compared to the 1990s, thanks to successive debt relief schemes or proactive national policies to curb external debt dependency. These concerns are now especially acute given the current context of global financial and economic crisis and its spillover effect to developing countries. So now the introduction. In this global context, we are going to work on the following question: external debt, short-term gain, long-term pain. We will investigate the relation that exists between financial opening and economic growth. We base our analysis on a paper of 2006, Financial Development, Financial Fragility and Growth. This article speaks about the financial intermediation and its role in growth of the economy in a country. This paper is a pre-crisis paper, and we exactly want to understand what authors may be omitted in their research regarding the appearance of the financial crisis of 2008, which propagated in the world financial system. The paper thus brings conclusion on the economic growth concerning a country by integrating a heterogeneous short-term effect for every country and a long-term homogeneous effect across countries. To answer the basic question, this paper was based on our reflection, even if we found an important limit. The studies and the results which emerge from the paper are realized at the national level. The external debt has an international character which authors do not get. The external debt is the portion of a country's debt that was borrowed from foreign lenders, including commercial banks, government, or international financial institutions. These loans, including interest, must usually be paid in the currency in which the loan was made. In order to earn the needed currency, the borrowing country may sell and export goods to the lender's country. Here is Belgium's external debt from 2007 to today. We can see the huge evolution of the external debt until the peak in autumn 2008, when the financial crisis and the regulators caused the tumble. So we will realize that the external debt leads a financial exchange and thus an interdependence between countries and more globally a risk of the system. Now an example with Belgium. If France has an external debt to Belgium, but US has an external debt to France, and Spain has a debt to US, if Spain make a default, USA could have some problem, but France too, and so Belgium finally. We agreed to bring an improvement to this paper by integrating the systemic effect. It is necessary to connect countries between them and not of taking country by country. Our model will be also better explained in the following part.
Now the theoretical part. Firstly, concerning the paper. The author analyzed how the financial development could have an impact on the economic growth. When they speak about financial development, they consider the financial liberalization. In turn, the financial liberalization implies, on the one hand, a positive effect on the economic activity via the improvement of the financial debt, and on the other hand, a negative impact because of financial volatility and crisis. So, their empirical results provide support with recent theoretical models arguing that financial liberalization can both generate short-run instability and higher long-run growth. The main conclusions of the paper were: first, there is a contradiction between short and long-run effects of financial intermediation on economic growth. Secondly, there is a negative correlation between short-run coefficient and fragility and crisis. Then, the level of fragility and crisis has an impact on the amplitude of negative short-term effect. And finally, the financial fragility has a negative impact on growth. So they conclude that the total effect of financial liberalization and intermediation may be a combination of these effects with weight for financial debt and financial fragility depending on the stage of financial development that the country is undergoing. An element to be highlighted is that when there are openings of the borders, banks cope with problems of asymmetry of information. Indeed, they do not have access to so much information about the countries, the sector, and the company that the foreign company which has it accredits. The bank will not anymore succeed in performing its function of the best of the manners. Moreover, with the financial openness, some banks could meet some difficulties with too big projects because of the lack of experience in the management of this kind of project scope. Now we would like to speak a little bit about systemic risk. Systemic risk refers to the risk of a breakdown of an entire system rather than only the failure of individual parts. In the financial context, it captures the risk of a cascading failure in the financial sectors caused by interlinkage within the financial system, resulting in a severe economic downturn. The policymakers have to investigate how to limit the build-up of systemic risk and contain crisis events when they do happen. Because of the role played by the finance in the economy, the consequences of systemic financial crisis are more devastating than those when crises arise in other economic sectors. Their following elements allow a better understanding of the systemic risk. So first, the endogenous risk. Financial markets are impacted by shocks from both outside the system, so the exogenous shocks, and from within, so the endogenous shocks. So the systemic risk principally arises from endogenous risk, which is created by and within the financial system and is then increased by the system. Amplification mechanism. The start of systemic crisis is usually due to a small event whose impact is amplified by connection within the financial system. That is when there are very close interlinkages between different elements of the financial system that systemic risks become a problem. In the worst case scenarios, that can lead to major crisis. The third element is the identifying crisis. Yeah, given the devastating damage that an outbreak of systemic financial crisis can imply, regulators, policymakers, and financial institutions have to become better at identifying the source and the development of systemic risk. The last element is the policy responses. Yeah, because regulators need to focus on policy initiatives that will counter the systemic risk and avoid those that, even if well-meaning, could lead to the creation of new and greater risks. It's important that policymakers study the financial system as a whole when they establish financial regulation and crisis responses. Now we are going to speak about data. So for data, the sample consists of 4 countries with annual data during the period from 1962 to 2013. In order to select countries, we focus on Belgium and select the 3 countries with which the Belgium has the most financial interconnection. To find information, we use the dataset International Bank Claims Consolidated Ultimate Risk Basis, which is realized and given by the Bank for International Settlement. So, the 3 selected countries in addition to Belgium are France, US and UK. We decided to include US because it's the country with the most external debt in the world and because US has been an important actor of the financial crisis in 2008. Concerning variables and their calculation, we decided to choose them in accordance with those used by authors in the paper. The dependent variable is the growth rate of GDP per capita. The measures of financial deepening of financial volatility and crisis are the variable of interest. The control variable are the government size, the trade openness, the inflation, and the education. In order to capture proportional effects, some variables are specified in nature log, and in the following table are presented some variables and their calculation or ratio. So the financial debt is equal to the ratio of the private domestic credit to GDP. The financial volatility is in fact equal to the square of the ratio of the growth rate of private domestic credit to GDP minus the mean of all the growth rates of private domestic credit to GDP. So systemic banking crisis, that's just a dummy where the value is 1 for the years when the country faced a banking crisis. The government size is just the ratio of government consumption to GDP. The trade openness is the ratio of import plus export to GDP. And finally, the education is the total enrollment in the secondary education expressed as a percentage of the population of official secondary education age. The majority of the data come from database available on the website of the World Bank.
So we enter now in the more technical part. We decided to work country by country to be really able to realize the influence which certain countries had on Belgium, but also which countries influence countries having an influence on Belgium. We decided to make a regression by country. In total, we thus have let us realize 4 regressions. The fact of working by country and with annual data, in spite of our sample begins in 1962, we arranged only 52 observations. Here is one of the limits of our research. Indeed, a limited number of observations doesn't allow us to possess a representative sample of the population. We will see later that it doubtless has a big impact on our results and our interpretations. So now the stationary process. As we decided to work in temporal series, one of the first questions to ask oneself is to know if our dependent variable is stationary or if there is a problem of non-stationarity. If we use a model MCO with a dependent non-stationary variable, the result will be totally falsified. Other types of models are thus recommended to mitigate this non-stationarity. The GDP per capita is clearly non-stationary of trend as we see graphically. Naturally, we can test non-stationary more formally with the test of decay failure. We see that the p-value is above 0.05 and we can conclude that GDP per capita is effectively non-stationary. This conclusion is the same for all GDP per capita variables of each country studied. In our case, it seems to us more judicious to take the growth of the GDP per capita as dependent variable, this one being more dynamic. While we verified, however, if this variable was generated by a stationary process thanks to the same test of decay failure. We can see that the p-value is below 0.05 and we can conclude that GDP per capita growth is generated by a stationary process. This conclusion is the same for all GDP per capita growth variables of each country studied. Now, the basic hypothesis to estimate a linear model. By knowing that our explained variable is stationary, we are going to look if our data respect well the hypothesis of the model's MCO. The reliability of the data is going to depend on hypothesis on which including the method MCO. So the first concerning the hypothesis 1. This one is respected for all the regressions because stata integrate itself a constant. The hypothesis 1 is thus respected for the 4 countries. Now for the hypothesis 2. To determine if the explanatory variables are independent from the error term, we decline the residues of the error term on these explanatory variables. We notice that p-value of this regression is upper to 0.05, what allows the conclusion that our models don't suffer from endogeneity. Now regarding the hypothesis 3. This hypothesis is respected for the regression of every studied country. Indeed, there is no variable in our models which has the same value during the studied period from 1962 to 2013. And finally, for the hypothesis 4. To test the autocorrelation, we realize a test for every regression. we noticed an absence of autocorrelation for the regression of Belgium, France and United States. Indeed, the three regressions of the error term present a p-value superior to 0.05. However, we noticed the presence of autocorrelation in the error term for the regression of United Kingdom. Indeed, the United Kingdom regression indicates a p-value lower than 0.05. To correct it, we made a regression by adding in our model an explanatory variable corresponding to the lagged one-pair dependent variables. Thanks to this manipulation, we eliminated the autocorrelation of the error term in the regression of the error term. Indeed, we don't reject the null hypothesis of autocorrelation given that the p-value of the Dublin test is now superior to 0.05. Now, the test of Breusch-Pagan shows that two regressions are homoscedastic, France and the US. Indeed, none of p-value of these two regressions of the error term in square is equal to 0. It means that we can reject the null hypothesis of homoscedasticity. However, with the low p-value for Belgium and United Kingdom, we suspect heteroscedasticity in these models. Consequently, we solved the problem by using for the latter the option robust in regressions.
So, after the check of the basic hypothesis of MCO models, we use this method and present in this section the specification of the four regressions. We decided to integrate only the variables related to countries with which Belgium has the most financial interconnection into our model. In fact, concerning control variables, has a low government size, low education, low trade openness, and inflation rate, we decided to not include these variables in the four countries regressions. We did that because they were strongly correlated and presented no significant coefficients. So the specification for Belgium regression is the following one. Now, concerning results, we decided to show you only the result from the Belgium regression. We note a p-value equal to 0 and a R-square of 41%. That means that at least one variable of our model is statistically significant. Moreover, our model explains 41% of the GDP per capita growth variable variations. In this case, as we thought it, there is a statistically significant effect at the threshold of 10%. When that a crisis starts in France, the growth of the GDP per capita in Belgium decreases. Thus, a crisis in France has a negative influence on the economic activity growth of Belgium. Now, concerning the results on the other regression, we provided statistical evidence that a crisis in Italy could negatively influence the economy of France. We have also demonstrated that a crisis in France could negatively influence the growth of economic activity in Belgium, in United Kingdom, and in US. So, in conclusion, the idea of our research was to go further that paper entitled Financial Development, Financial Fragility and Growth, which just concerned the impact of the financial intermediation on the growth of a country. As a reminder, the paper provides that the effect diverge according to the short-term effects or long-term effect, and the situation of financial development in which every country was. Here the question is external debt, short-term gain, or long-term pain. In view of the recent crisis, our ambition was to integrate the idea of systemic risk so as to study how the financial interconnection between various countries could have fatal effect on the growth of a specific country. In spite of the obvious contagion proved in the theoretical way, it was difficult to us to prove it in practice. With the limited number of observations in our database resulting from the timing which was restricted, only some result can be presented to you. There is thus a lack of precision in our model. We can show you some significant examples. So a crisis arising in Italy could lead to a decrease of the financial and economic health of France. Or a crisis arising in France could lead to a decrease of the financial and economic health of UK, US, and Belgium. In other words, in spite of the few results, we can justify the theory which approaches the problem of the financial contagions. A country being in stress could bring trouble to another country, if they are financially connected, of course, and so on. However, the financial crisis being over, we notice that the economic growth resumes quite slowly positive looks. We'll thus conclude that in the short term, the effect can be very negative, collapse of the financial system as a whole in 2008, for example. But on the long term, on the long run, it seems to turn out to be positive, so a renewal of the economic growth. Finally, we would like to finish our presentation with some limits and criticism. So, let us notice that a large number of variables considered at the beginning were removed from the specification of the final regression. The cause is a too strong correlation between these variables, a positive counterintuitive signs of the departure, and the lack of observation of our sample. With much more time, we would have been able to go further in the modeling of the fragility and the financial volatility, and to increase our frequency and the number of observations. It could be interesting to realize more researches in other papers and to see how they approximate the financial fragility. In the theory, other authors use model difference for similar researches. Would other model give more information and better result from the economic analysis? So thank you for your attention.